Welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Alright then, let's head into today's conversation.
Hello to our audience today. We are having a conversation about how to compare investments today. We had initially planned for sort of a life lesson kind of story where we would have a my money conversation with Deborah, but she's under the weather. So we'll be taking another topic just to have some company here. Adam, I'm bringing you up. Do join me. In fact, I should have added you to the main speaker. So, a question I was asked earlier this week, and pardon the distance and the noise in the background. I'm almost at home. Just the traffic, just to get to my junction. Interested. Anyway, so Adam, how you doing? Hello, Adam. Can you hear me? If you are speaking, you are muted. But okay, I'll circle back to Adam. All right. So today's conversation is about how to compare investments. Very often people ask me, oh, Charlie, what investments do you have at your company? Then I mentioned multiple products. Then they are wondering, how does this compare? And even more so, how does it compare with competitors? So today's conversation would help give us some pointers to look at, to know the things to look out for at different investment houses or different banks when we are considering different investments that we are going to make. So it's nice to have you here with me, and I welcome Adam and David on stage. David, can you hear me? Adam, can you hear me?
Yeah, I can hear you.
It's loud and clear.
Okay, great. So I was speaking to myself for a moment. Okay, I hope you're all doing well and you had a good week.
Yes, we did.
Okay, David, in your line of business especially, you get people asking this kind of question. Is this something that comes up often where people compare different types of investments, or is it something that people just come to you or ask you directly about just one investment, like their minds are already made up? Is this a scenario that plays out?
Hardly ever do I get something about direct, specific about something, an investment. It's always, what is this? How does that compare to this? What's the difference between, this and that? And what if I get it from Elikem versus getting it from Adam? What does that mean and all of that? So yes, I get it a lot.
That's great. So hopefully this conversation will be relevant to a lot of people. Don't we just wish it was like a uniform or a template for all investment houses or all banks or all types of investments, so that we can simply just take a pamphlet and compare across. But there are some nuances here and there. There are different terms used in different places. So today we'll be having that conversation. First thing I would like to bring up, and if you were in on those conversations in January and February, you'd realize that there are different types of investments. So the first thing you want to note is whether you are comparing across different investments. David, what kind of different investments do you know of?
I think you got cut off a little bit, but I think I heard what types of different investments do I deal with?
Yes.
Is that the question?
Yes. What type of investments do you deal with on your side?
So I deal with the mutual funds, the equities, which is shares or stocks, as we call it in Ghana, the fixed income side, the bonds and stuff, and then we've got the if anything, when it comes to the equities, there's different types of it, the options, all of that. So yes, those are some of the ones that I deal with.
Okay, so it's not too far from what we also deal with in Ghana.
The same stuff.
Yeah. Well,
Different
I guess
locations.
The differences come when you are talking about the more sophisticated things with the higher net worth people, and also when people start comparing like real estate investments, crypto, and all those other sophisticated things to the normal, traditional, plain vanilla kind of investment, right?
That's true. Yes.
Yeah. Okay. So hopefully we would look at certain terms that you can look to cut across even the sophisticated ones. Sometimes they will come with wild names. Crypto this, crypto that, blockchain this. Why am I on the crypto people today? I don't know. But sometimes it's like the good book says, there's nothing new under the sun, right? So the first thing I want to look at is investment objectives. I think that's the first thing that anybody needs to think about whenever they are considering an investment. Why do you want to put this money away? In Ghana, especially in my experience with people usually just invest money and they don't necessarily have a particular reason why they are investing the money. All they know is they want to put the money away. In light of that, I think it's fair. Sometimes you just hit some windfall and you don't know what you are going to do with it. That's fair. But sometimes too, it's good to have a financial plan for yourself, so that you know that when this money comes, this portion of your salary comes, you know that it's going towards this, and it's gonna help you to point in the right direction and go look at the kind of investment that will meet your objectives. What do I mean by an investment objective? Let's say you have a desire to pay rent in a year. You've just finished paying 1 year advance or 2 year advance, and you know that you need some money in future, so you want to set some money aside every month towards that goal. Now that goal is different from someone who is thinking about the only thing that they need to save towards is their retirement in 20 years. There are two different scenarios. Someone wants to pay for school fees. That's a whole different ball game, right? So understanding this objective will help you choose between different types of investments. David, any thoughts on the need for an investment objective?
The need, yes. So just like you were saying, to have an objective, you need to know, okay, this money that I'm using to invest in stuff, how long am I willing to part with it? What does that mean to me? If and I'm going a bit into friends saying risk tolerance here, but then also know if things start to go downhill, how much of it am I willing to lose and still be okay? And you were mentioning something about what you're going to use the money for. So all of these need to be looked at so that somebody can put you, because you don't if somebody, let's say, wants to invest for their retirement and they are 25 years old, and another person wants to invest for their retirement and they are 50 years old. Yes, they are both trying to invest for retirement, but any educated investment professional will put these two people in different things, entirely different things. What you say to one will be different from what you say to the other. They are both trying to invest for retirement. But then when you look at their age and how long it's going to take for them to want to start recouping some of this money, then things kind of go in different ways. So yes, it's very important to have that. Thank you.
Yeah, that's true, and I even like the way you got the nuance. Even if two people are investing towards retirement, there could still be some differences in there. Jenny, how about you? You are getting a lot of experience talking to people about investments and their objectives and how you are structuring your portfolios. Any thoughts about how investment objectives help you determine the investments to do for them?
Okay, good evening to everybody. So, investments objectives are very important because it shows the suitability of securities or let's say investments that can be bought by the person who is doing the investments. And I'm really appreciating that now because even in, let's say, you say that, this security is a government of Ghana security, so it is less risk. Some people want it short because of certain objectives they have. Let's say they are just investing for school in the next 2 years, or they are doing a retirement planning for like 20 years. So all of these things will determine what you buy for them. So I'm really appreciating that concept now in like my work. So yeah, as Edikem said, we are really coming very close to that, and it's very important again because um even stocks. We have stocks that pay dividends and we have stocks that hardly pay dividend. Then they say that they reinvest their gains back into the company. If an investor wants to be getting periodic income from his even his equity components, this also helps him with something like that. So it makes you be able to differentiate between the needs of clients and then the security that will meet the needs of these particular clients. Thank you.
Yeah, helps you to differentiate. I like that word you use, suitable. That's suitability. To each man his own. There no two people are alike. You and your twin brother or twin sister could have very different interests and very different needs, even you and your partner, right? Adam, I'm curious, from your standpoint as someone who invests for yourself, have you have you ever had to sit down and think about your investment objective?
Yeah. Edgar, good evening once again.
Good.
With actually, okay, when I first began this whole thing about investing, yeah, I just knew that I wanted money. So I was just doing it. So
That's a good objective, Charlie. The objective is to get the money.
exactly. And so the first time I think my first exposure was EPAC at the time. And we all were just going with the bandwagon and all of that. And subsequently I started reading and I realized that, oh no, objectives are very important. And for me, as someone who is into projects, every project has an objective. So I can see my investments as a project that I'm embarking on. So subsequently, I've had to now begin to look at what's the reason why I'm investing for this. So for some of them, I was planning to go and do my master's, so I put together some of the things in some investments. Some to you start to say, okay, I'm preparing and putting aside to do a project and all that. So subsequently, it wasn't something that was there from the beginning, but as I started reading and studying, then I got to know that investment objectives are very important. Yes. So that's how for me as an individual I've seen it play in my life.
Okay, that's great. That's great. And just to um, clarify, especially because Eden brought that angle, some people may have an objective. I'm going to buy a house. I'm going to buy a car. I'm going to do wedding. Charlie, it's a perfectly fine objective for your investment to say, I want the highest possible return. In fact, I prefer when I'm managing investments for clients, I prefer those clients, or not that I prefer, the clients whose objectives are purely to make the most return. They make my life easier. The decisions are simple. Charlie, this thing we are doing, are we going to make money or not? Oh, I want a stock that will pay dividends. I'm sure Jennifer is eyeing me right now. It's a topic that I keep talking about at work. If you want to make returns, Charlie, don't go for stocks that are going there with the expectation of getting dividend. That kind of thing. Let's go for the stocks that will double in no time. That kind of risk profile is what I look out for with those clients. So they even make my life simpler. Okay, great. So now let's move on to another thing. You've determined your investment objective. So then it helps you narrow down. If you are investing for a long time, you know that you can go for for long-term bonds, or you can go for the equity type of investments, right? But if you are doing a short term, then you know that Charlie, your portion is treasury bill or a mutual fund that's invested on the short term. So we call some money market mutual funds, we call some cash trust and the likes. So that's where you should be looking at. There's another term which you also need to use to compare. It's about risk. With the investment, we talk about risk and return. So you need to look at the different types of investments that you've narrowed it down to. What are the risk profiles in there? So let's talk a little bit about risk profile. Jenny, tell me what is risk in terms of investment? Like, what do you mean by that word?
Okay. So risk is the probability or possibility that the expected let's say return or interest, that's or no, okay, so the expected outcome of an investment is not obtained. So for instance, let's say I'm giving a company a loan, and they've told me that if I give them 1 million, they'll pay me 25% by the end of the year. So by the end of the year, I'm supposed to be getting my principal of 1 million back, and then 250,000 CDs back. There's risk that I can get above the 250,000 that they said they'll give me for interest. So I can get my principal, I can get the return that they told me they'll give me, and even more. That is one part of the risk. Another aspect is that I can get lower than the interest they told me, or so lower up to zero. I can even they may even not pay me the interest, or they may not even add the principal and then the interest. So the risk is that the outcome of 1,250,000 that they said I was going to get at the end of 1 year will not be realized. Yes. Thank you.
Okay, great. So basically, the possibility of financial heartbreak.
Yes, please. In this trying
Yeah,
time.
they serve you. Yeah, and in finance, technically speaking, there's actually positive surprise and negative surprise, but I guess we are not worried about the positive surprise. Like if someone said they'll give me 20% and they end up giving me 30%, I know, but I'll take it like that, right? Okay, good. So why does risk matter? Right? Risk matters because it's all about how much of it you can tolerate. We say that the higher the risk, the higher the return. So some people can tolerate more risk. For those people, they should look at investments that can do that. They can take more risk with the potential of getting higher returns. Let me give you a more practical example. Someone young, straight out of university, the person is sorted, doesn't have too many bills to pay. Parents give the person a car, right? Everything is fine. The person is looking to invest for the long term. This person can look to invest in equities, or perhaps not even anybody at all may want to look at it in terms of the risk profile. Equities versus you do a treasury bill. Now these two are kind of on two ends of the spectrum. Treasury bill is low risk, whereas equities are high risk. By equities, I mean you own shares in a company. Another name is stocks, right? You're a shareholder. When you look at these two risk profiles, you have to understand that they are very different. So the different types of investments has given you a clear sense of the different risk profile. But that's one way of looking at differentiating in terms of risk. Sometimes they can be two similar investments in the sense that they are the same type. You may have two treasury bills. Treasury bill by the United States government versus the treasury bill by the government of Ghana. These are two different ones. And perhaps at this point, David, let me tap into your knowledge. How would these two different treasury bills, or how would these two treasury bills differ in terms of risk profile? Can you shed some light on that?
So, I don't know if Ghana has ever defaulted on any of their financial obligations, but then they differ in terms of which one of these two countries is more likely to maybe go broke. And no offense, I'm Ghanaian, I love my country, but Ghana, we might go broke and decide to say it means KB. Whereas United States, they print the money over there until the day they are okay. So of course, the one for the United States, and that won't be less riskier than the one for Ghana. Thank you.
Yep, that's true. Who is more likely to not pay, right? And if you are less likely to pay the money back, then you would attract a higher risk. So people would say they want a higher return on their investments. So, and even this is on treasury bills, where we know that treasury bills are some of the safest investments, right? Let me make this clarification. When it comes to investments, there's no zero risk investment. There's no safe, 100% safe investment. There's always that possibility, even if the possibility is 0.00001% that there may be a default. It's still there. It's not perfect, right? So just keep that in mind. So, like David mentioned, you have both treasury bills, both governments that have the power to print money, both governments that have power to raise taxes, but still, the one is stronger, or one is seen financially stronger than the other. So that brings a different level of risk profile. So with this, you can compare them. You can also look at it this way. Besides just sovereigns, you can look at it as, compare a bank, let's say GCB Bank, Government of Ghana. GCB Bank would attract a little more risk because they are a private entity. They are a bank, yes, one of the biggest banks in Ghana, yes, that's true. They are strong, all right. But the government should, on a normal day, should be a safer option than GCB. They are still a private entity. There are still shareholders involved. They are still exposed to the market forces. And if business doesn't go well, then it's on them. They have no other recourse. But then we go even further down the line. Maybe a smaller bank, maybe Cow Bank, not as big as GCB. Their reserves may not be as big as GCB. They are still a good financial institution, but they are smaller. They may be seen as as a little more risky than GCB. Then we can still go further down, whereas we are getting into maybe the savings and loan spaces. Although they are all banks, they are seen as having the Bank of Ghana protections, the rules and regulations to make sure that the money is kept somewhat safely, But there are still levels to it, with investments, there are always levels to it. So the further down you go, or the further away you go from the government and then safe structures, the more risk you are attracting. Then we come to even private institutions where someone can just say, well, I'm not even a financial institution. I'm any institution doing business. Come and lend me money. Give me a loan. So anyone can go to the bank and raise a loan for their business. Now that's even more risky than a normal bank. So you need to look at their balance sheet and all that, But usually with the formal investments, we are not even talking in terms of loans, but it gives you that sense of what risk is from person to person, even among your friends. I'm sure you have some friends who are doing very well, come from rich home, they have a very good job, they have, like, things are going well. And I'm not even talking just the flashy things, whether they have a flashy car or not. You can see that these people are financially stable. There's someone, Charlie, the person doesn't have so much money. Person is probably just out of a job, a lot of expenses on their necks. You can compare that risk. So when it comes to investments too, you can do the same with issuers, or we call them issuers, or companies where you can go and invest. So you go to company A, you go to David's company, Charlie David. I'm looking at David like a few years ago when he was not an industry regulator. So you go to David's company and say, okay, such and such, this is how you people are performing, this is what the kind of investment options you have. Then you go to another company and say that, okay, what investment packages do you have? Now you're comparing these two companies, and you have to find a metric to be able to compare and say, no, I think this institution is stronger than the other one. And with that, there's always a good proxy that you can use. Start from the Bank of Ghana, the Bank of Ghana publishing the treasury bill rates, it gives you a sense of how much risk comes to play. And as I introduce this topic, it brings you to the other leg of risk and return. All right. Do you know the return that you are going to get? In most investments that we do, they usually quote an interest rate. There are different ways you can get your returns. Jenny, would you want to highlight some of the different ways people can get their returns before I explain the interest rate side of things?
The line was really breaking. I don't know if it was me. Please repeat the question.
Okay. So I was saying that we've talked so far about risk. Now to talk about the other end, it's return. And we normally know about the interest rates, but there are other ways of getting your returns. So can you give us some of those ways that people can get returns in investment?
Okay. So you can get returns by basically investing and not putting your money under your bed or in just a savings account. So, for instance, as Elikem said, there's no zero risk, but the government is the closest we have to a risk-free investment because come rain or high water, if anything happens, they will either print more money to pay you or they will increase taxes to pay you. So that you get returns by investing, let's say, the government, and that is the closest, like the floor or the least return that you can get because the risk is quite low. So currently, Bank of Ghana, Government of Ghana Treasury Bill 91 days about I think 17.51%. So when you go up, if let's say you go to a corporate institution, let's say for instance we have some institutions like Bayport. They are a non-bank financial institution where they collect deposits. Like you can give them money for a fixed deposit and all of that, and then they use your money to work and then pay you back. So somebody like that, they'll have to pay you above what the government is paying for a 91-day security. So I think it will be hovering. I'm not. This is not the exact interest rates that Bayport is giving, but I'm just using it as an example. So let's say Bayport will have to give you about 21% or 22% for let's say a 1 year or so security. That is causing an increase in return. As you go on the risky investments, the expected return that you are supposed to get is supposed to go up. So for instance, when you go to the stock exchange collects your money, and then the rationale behind it is that they are going to work with your money and then give you, as the company's value goes up, the value of your securities that you hold, which is the shares, also go up. So, and the difference between what you bought it at and then what you are currently holding it at will give you an interest. So, for instance, you bought a security, let's say company A, let's call it Jennifer's company, and you bought it at 1 CD. My company is doing quite well. My profits is growing year after year. My business is sound, and it is, we call something a going concern, which means that in the foreseeable future, barring any cataclysmic shocks, I am going to be in business for some time to come. And because of such good financials and fundamentals, the stock that you bought for 1 CD is currently at, let's say, 3 CDs, which means that your investments or your returns have almost tripled because you bought at 1 CD and now it's 3 CDs. So that return on the number of shares you bought can also serve as a means of getting return or interest. Yes. Thank you, Edikim. If I've left something out, please add it.
Great. That was a good illustration. So Jennifer started with the interest rate, the normal one that we know, interest rates. You invest your money and get some returns at the end in terms of interest. And then the second way is capital gains. That's when you buy shares at a certain price and then you sell it in future at another price to make the gains. It's interesting how we all understand capital gains, but when it comes to actual practice of investing, people prefer to go the principal plus interest way, but it's like buying any piece of land. In fact, pardon me, let me take a step back. There's yet another way we can earn interest. So we've talked about interest rates, we've talked about capital gains. Another word you can use for capital gains is profit, right? And the third way is to talk about the dividends that you can earn on the investment. What's dividend? Dividend is when you invest in a company, you are a shareholder, and they make profits at the end of the year, and they decide that they want to share some of the profits with the shareholders. So just today, for example, Ben's Oil Palm Plantation, a company listed on the Ghana Stock Exchange, issued an announcement that they are going to be paying dividends very soon. And it's 1 pesos per share about. And that gives people who are shareholders of BOP, let me call them BOP, it gives those shareholders on a certain given day 1 cedis per share. So if you have 100 shares, that means you'll be getting 106 cedis when they pay the dividend. So that's a way that you can participate in the returns of the company, right? So you add this to your capital gains and that gives you your total returns. Now, these three forms are the general ways, right? But when you want to compare investments across two different types of investments, don't think about it in terms of returns or in terms of, interest rates. Otherwise, if you are looking at a share type of investment, you bought stocks, you won't get an interest rate. That's not how we call it. Rather, use the word returns. All right. So if you've not heard anything at all in today's conversation, remember that you should now start transitioning your mind into thinking of what is the returns on the investment. Now, when you think about it in terms of returns, it says that what is returned to you for owning this investment? What do you get back? Then you can adapt to the different types of investments. That way, when someone says that, oh, on one hand, you can buy this investment in a mutual fund or shares, and then another person says, no, come and do a bank fixed deposit with me. Now you can compare the rates because you know that if it is bank fixed deposit, I'm thinking interest rate. But if it is shares, I'm thinking capital gains plus dividends. Personally, I would say don't think so much about dividends because it's not guaranteed. But well, let's look at it in terms of total return. In light of that, you can you will then ask whoever is telling you about these investments, what is your historical return? Especially for the share-based types of investments, that's stocks, mutual funds, even if it's real estate. Maybe someone says, come and buy a plot of land because we think that, oh, in this area, you can buy a plot of land for 5,000 cedis today and then next year you sell it at 7,000 cedis. You see, that's capital gains. That's profit. So it's nothing too weird. But just when people go into a financial institution, they expect to see principal plus return. And when they don't see principal plus return, principal plus interest, they get confused and they think someone is trying to sell something bad to them. Don't worry, keep calm. It's just the feature of this type of investment that you are doing. So you ask about this information and they tell you that, okay, this stock did maybe 20% in the last year. Ghana Stock Exchange, the composite index did 38% last year. Then you ask the mutual fund, what did they do last year? They did 20% last year. Then now you can compare it with what was your fixed deposit returns or interest rate on your fixed deposit for last year, and they will say 15% or 20% or 30%. Now you have that something that you can put as a way of put them on the same level. So a common, should I call it a common denominator? All right, to say that okay, then this one is higher than that one, this one is higher than that one. You get the idea. That will serve as a way for you to compare investments and make an easier decision. You don't have to worry that someone is speaking someone is speaking one language and another person is speaking another language. Before I move on to something else or the different ways that interest rates are quoted, Jenny, David, would you want to make any comments about the different ways people earn returns on their investments? Have we exhausted it?
I think we've exhausted those because it's just three main ones: the interest, the dividends, and then the capital gains or capital appreciation, like you said. So I think that's it.
Okay. All right. Okay. Great. Then now let's so we've established these returns and interest, right? So now I'm going to speak generally and say returns. Some people may quote them to you in different ways. On a normal day, when you are given a certain percentage, it's safe to assume that it is an annual rate. If the bank tells you that do a treasury bill at 16%, it is an annual rate. Even though you are doing a 3-month treasury bill, that's 91-day treasury bill, you shouldn't expect to get, let's say, if it's 16% and you invest 100 CDs, don't expect to get 16 CDs as interest at the end of 3 months. No. You will only be around for 3 months out of 12 months. So you have to do the math and divide the 16 by 4 because there are 4 3-month periods. If you are going to be there for 6 months, that's 182 days. That's half of a year. So you divide the 16% by to give you 8, and then you can say that okay, you get 8 CDs at the end of your 6-month period. So normally interest rates are quoted per annum. I'll tell you this interesting story. So I was fortunate to have my mother put my susu in the bank for me very early on. So I used to do susu, and then she would go and buy treasury bills. When I got into university, with all the youthful exuberance of a business student, I said that now I've calculated my treasury bill and they are cheating me. At the time, the good old days of this was 2011 and 2012, interest rates on treasury bills were around 9% to 11%. I remember when it went up to 11%, I was so happy. When I went there, I said they were cheating me. Why are they cheating me? Because I was expecting to have gotten 10% of my money at the end of 3 months. Then the relationship manager just looked at me, shook her head, and just said, "No, it's not correct." In my defense, she should have explained it to me properly. But listen to me, I was like, "Nah, I'm a business student. I've done the math." And now looking back 80 years later, I'm like, "Oh no, can you just imagine what this woman was saying in her head? The way she was insulting me." I remember, Societe General, Ring Road branch. Anyway, it was a rookie mistake I was making. Remember, interest rates are quoted on a per annum basis. If you are not going to stick around for the whole year, divide it by the number of months that you are going to be there, or the portion of the year that you'll be there. If you be there for just half a year or 6 months, then you divide the rate. You divide the rate by 2 because you are going to be there for half a year. Okay, another term that you would hear is year to date. And at year to date, it gets a bit tricky. David, would you like to help us out with year to date, with that term year to date, and what someone should ask for instead when they see year to date?
So year to date is pretty much just from day one, which is January 1 to whatever date that is. So if let's say you are doing, I don't know, you get like a 10% per annum, then you divide that by the month, and then maybe you're in month 6. So that'll be half of that. So year to date just basically means from January 1 up until that ever date that you're having this discussion. So it kind of fluctuates. So if you don't know exactly what's happening, I think that the year to date can be a bit tricky for you. So just know what the annual rate is, and then that kind of gives you a general idea of what it is that your investment is making. Thank you.
Great. Year to date can be quite tricky, and the scale always changes. As at end of March, it's 3 months. As at June, it's 6 months. So we just always want to make sure that we are looking at a full year thing. I'll just ask for the year, the annual rate, right? So now in looking to move from year to date, if we are asking them for an annual rate, Jenny, I think an alternative that they can give you is year on year. Can you tell us more about what the year on year rate tells you?
Okay, so the year on year rate tells you that from a year ago this date till today, what is that year, what has been the performance of the investment you are looking at, if it's a mutual fund. So for instance, today is 5th May 2022. So if you see any year on year return for an investment today, it means that from 5th May 2021 till today, that has been the return of the investment. So let's say M Fund, that has been the return of M Fund in 1 year from 5th May till 5th May this year. It is very, so that one is more holistic, because at least it gives you a 1 year return of the investment, and it makes you be able to gauge that if this is 1 year, if I'm doing 4 months, even though we are not guaranteeing that you get the same thing, it gives you a rough idea of what the investments can do. Yeah, thank you.
Great, thank you for that. And I like those words you have introduced, guarantee, and we'll get to that in a second. But yeah, just a recap. Remember that the year on year just tells you that if you had invested your money as at last year, 5th May 2021, to today, your money would have grown by this much. Now, why are we fussing so much talking about different types of rates and all that? Why isn't it just simple? It's because of what Jennifer said. not every investment can give you guaranteed returns. There are very few investments that can guarantee you a return. What does it mean? It means if you go and put your money in that investment, can they tell you that, okay, we will give you 18% in 1 year? So go and come back in 1 year and you'll get your principal plus 18%. Very few companies or very few institutions are allowed to do that. It starts from the government with the treasury investments, treasury bills, treasury bonds, because they have such power to raise taxes, to print money. They can actually tell you that, you know what, go and come back in 1 year. It's 18%. I will give you 18%. So they have those guarantees. The commercial banks or universal banks, where chances are where you keep your current account and your savings account, they can also do that. The savings and loans can also do that. They can do that because they are made to do very prudent or safe kind of investments or make a lot of provisions. I won't get too technical, but they are made to do a lot of things to make sure that they can collect money when they give it. So that if when people come back for their money, they are able to give them their money back with the returns that they promised. So with those ones, there are a lot of structures in there. Of course, you can also do a loan. You can go to any institution and they will tell you that, oh, we'll give you a certain fixed amount of return. But at that point, it starts getting a bit loose. You are just going to keep your fingers crossed and hope that they can give you the money. So that's another thing that you need to be concerned about. With a lot of the investment houses, I would say if you want to invest, don't go to your bank. They'll give you much lower returns and they'll find a way to benefit off you. Rather, go to an investment house, go to a brokerage house, asset management. If you're in Ghana, those are some of the ways you should be looking for. Fund management, asset management, brokerage, they can get you good investments at good returns. And when you go to those kind of institutions, they only buy the investment on your behalf. You are not giving them the money to go and give out loans. No. When you go to a bank, it's the bank that owes you. But when you go to these investment houses, they are going to buy an investment on your behalf. So if it is a treasury bill that you want, they will take your money and go and give the money to the government and say that, well, government of Ghana, Adam says he wants to lend you money. So here's 1,000 cedis. You get the idea. They don't owe you. So if the government doesn't pay, or they go and do a bank fixed deposit with another bank, GCB or something, and the bank doesn't pay, you actually can't hold the investment house that they must pay you, because they don't have the necessary structures to make sure that they can pay clients like that. They only buy investments on behalf of other people. And this risk is something that we really need to appreciate. People think once you go to a finance house or an investment company, they must pay your money back. I really wish it were the case, but the reality on the ground is not the case, and things can happen. So you have to appreciate risk. If you don't want to take on so much risk and you just want your money to be safe, your best bet is to just do treasury bills and you'll be fine. Same way if you want to buy shares and you go to a brokerage house and you ask them to buy shares on your behalf, or you go to a mutual fund and ask them to buy shares, it's all about how well the company will perform. If you buy shares in Fan Milk and the value goes up, it's yours to benefit. If it goes down, it's yours to lose. You can't hold the investment house that bought it for you. You can't hold a brokerage company that, well, I brought 1,000 cedis. Now my 1,000 cedis is worth 800 cedis, so give me the 200 cedis balance. No, you can't do that, right? So once you appreciate these nuances, then you know that if you can't stomach that the possibility of the loss, then just do treasury bill. But if you are willing to take on that risk, because we are talking about losing, but sometimes these investments that we are saying that they have the possibility of losing, they even have the possibility of doubling in 1 year. Fan Milk in 2021 is a clear example. But people forget that before Fan Milk got to this point, it had lost about 90% in the space of 2-3 years. So all these things are things you need to understand to be able to compare different types of investments. But once you see that investments are, we are comparing a treasury bill with a mutual fund, or even mutual funds, fixed income mutual fund with equity mutual fund, then you know that there are some of these differences that you need to pay attention to. It may sound a bit technical, but when you are talking to whoever you are trying to do the investment with, they should tell you this. They should tell you that this is a fixed income mutual fund. Okay, so ask them these questions. We wouldn't be, Jennifer, David, and I wouldn't be there with you, but we hope you get to ask them the questions. Make sure that they are able to explain things to you for you to understand, so that you can properly compare, so that you know that when you go to the Daylex, it is going to be a fixed deposit or a term deposit. But if you go to Databank Asset Management, it's going to be a mutual fund. If you go to Stanbic Investment, it's going to be a unit trust. You know, all these things are things that you need to know differently and understand that, oh, because they are different, this is how I should see it. And this one comes with more risk than the other one. Okay, great. So with the bulk of the technicalities done, right, there are a few other things that you need to compare with. Liquidity. Liquidity is how soon you can get your money if you want to do a withdrawal, if you want to close your investment or you want a portion of your investment back. How fast can you get it without losing some value? So I'll start with various spectrums. Jennifer, with treasury bills, how liquid are they? How easy is it for people to get their money out of it, and do they incur any charges?
For treasury bills, so I will start with how easy it is to get your money out. So let's say your treasury bills usually mature on Mondays. So let's say your treasury bill is maturing on a Monday. Sorry, and you don't want them to roll it over. Usually you have to give instructions for them to roll it over or not. But let's say you don't give them instructions for them to roll it over. On the Thursday before the next Monday, if you don't already have your bank details on where they should pay you, you can just go and tell them that your treasury bills that are maturing, you want them to transfer it to this bank account. On the Monday that it is maturing, your money will be paid to you and nothing will be amiss. Now, so that's in a normal course of business. Your money is maturing. It takes like 3 working days from the Thursday when you give them the instructions till the Monday when you get your money. That one, there's no charge. Now, in case, let's say something has happened to you, instead of you waiting for the 3 months for you, if you did a 91-day treasury bill, in let's say 2 months or so, you had an emergency and you wanted them to discount your bill, like stop the investment, for lack of a better word, and give you your money. Now you can get the money. I'm not really sure about it, but I think in another 3 working days or so, you can get your money. But the thing is that it's not as easy as just coming and saying that I said I was doing 3 months, I won't do again, I've stopped. You can't just do that. So we have a discount rate that they apply depending on how long you have stayed in the investment. So if you've stayed in the investment, let's say today is 5th May, you did it a month ago, the rates right now will be steeper. So the discount rate will be quite more than, let's say, if you stay in it 2 months and 3 weeks. As you get towards the day that you are supposed to get your investments back, the discount rate becomes a little more relaxed. So then they work the discount rate against the money, the treasury bill that you have, and then they give you your money back, less the quote unquote penalty, the discounts that they took from it. So it's when you do treasury bills, it's not just easy like that. That when your money, or it is easy, but then it comes at a cost, a financial loss. To say that I don't want to stay in this investment till the day that I said I will stay in it till that. Yes, Medicam. So when you get to mutual funds, I would like to juxtapose this with that. Thank you.
Okay, that's great. In fact, I think you should let me just do a quick recap. So basically, with the treasury bills, it is, even though it's a safe option, if you decide to break your investment before the 91 days or the 182 days or the 1 year, then what you realize is you may be hit with a charge. In fact, there's another angle with treasury bonds. That one, you may profit or you may lose. So every time before you enter into this investment, you should ask whichever investment house or bank that you are talking to about the possibility of such charges or such losses when you are coming out. Now, let's compare that with mutual funds. Jenny, and you wanted to get in there.
Okay. So with mutual funds, when you want to, so I'd like to start with a fixed income mutual fund for the meantime. An example is M funds. So if you want to do an M fund, and we also recommend that you have that for at least 3 months, and the 3 months is up. So with M fund, they don't have like a maturity date. Usually mutual funds and unit trusts don't have a maturity date. They have a minimum recommended holding period, which is the least time they recommend that you hold the investment. So M fund is 3 months. When the 3 months is up, or any time after the 3 months you want to go and withdraw your money, you just go to them and give them 3 working days notice. And the money, if you want it to be transferred to your bank account, the money will be transferred to your bank account, and nothing will happen. Like, you won't be charged or anything, because you'd have been charged a front load. So a front load is it is not for everybody, but usually fixed income funds are front loads, and that is whenever you are bringing a deposit, they charge you a percentage. For M fund, it's 1%. So when you are making a withdrawal, no matter the time you are making the withdrawal, there's no charge on it. So it just takes 3 working days for you to withdraw your money. And so then, as I was saying, this compared to the treasury bill, where the treasury bill, if you haven't gotten to the maturity date, there will be a charge that you have to bear. With mutual funds, you just have to give them the notice, and then the recommended days that they say give them for them to give you your money, they'll give it back to you. For equity mutual funds and some balance funds, sometimes they recommend that you hold the investment for, let's say, 5 years or some time. I'm using 5 years as an example. So if they say that hold it for 5 years, and let's say sometime before the 5-year mark, you need your money, usually they have an exit load charge that they charge you. And sometimes it is, let's say, a percentage, depending on the number of years you have held the investments. It will be a percentage on the withdrawal amount that you are withdrawing. So there are different companies that do different things, but this is sort of an overview or a broad stroke across it. So for long-term investments, usually there are balance funds, which have a component of fixed income like treasury bills, and then shares or equities, and then pure equity funds. They do something like this. Thank you.
Great. So you can see that. Okay, in fact, David, do you want to also add on to this point?
Yeah, I was going to say that because of stuff like this that you guys are talking about in terms of your early withdrawals and all these other things that could impact the rate of return that you receive, in my part of the world, the word guarantee when it comes to investment returns is highly, highly discouraged. Using that word guarantee, you're guaranteed to get 5% on this investment is very, very highly discouraged, because so many things could happen that maybe your client will want to pull their money early or whatever that could impact that rate of return that you're telling them that this thing is going to give you. So yeah, I just wanted to throw that out there. Thank you.
David, this matter of guaranteed return that you're talking about is interesting. I was talking to someone who consults for the Ghana SEC, and especially with real estate investments. I see people advertising real estate, like come and buy this house, a billboard, houses or apartments for sale, and they say 12% rental income guaranteed, or 12% return on investment guaranteed. I'm like, what's the SEC doing about this thing? Because some of these words, you can't see it. You just can't see it. So yeah, anyway, so let's be careful. This is a word of advice. If you are listening to this, be careful whenever someone uses the word guarantee. Uses words like promising, anything that's talking about definite future, like well. If you pay attention to the way Jennifer and I and David talk, and maybe we usually talk like would, may, can. Never anything is ever so definite like this way.
Up to. You can get a return up to 15%. Never guaranteed 15%.
Yeah. So when you hear someone talking like that, then you know that, okay, this person is not being overly confident, and At least there's some, you can trust the person to some extent, as opposed to someone who say, "Oh, this will happen. This really you don't call me." Anyway. So back to the issue of the exit charges and when you are the things that will happen when you are withdrawing. Why is all this important? You need to know how you get out right from the beginning, so that if it is money that you are keeping invested, let's say you are going to travel and you are just waiting for to hear a go ahead, or you are waiting for school applications to come through, or am I using these examples? Like, or you have a business deal, you don't know when they'll call you to come and deliver the contract, but you have the money sitting somewhere. Don't go and lock it in a treasury bill because you may be charged when you're coming out. Don't go and buy shares. Definitely don't. Don't go and buy any type of investment that when you need your money, you can't access it quickly. It may take a few days or weeks for you to get your money back. If it is an emergency fund, money that you've designated actually, if you are pie, this is the kind of investment you can use. You can you can go and disinvest from and get your cash so that you do something with it. That kind of investment, always keep it in something that the company that you're investing with, they've told you that, oh, don't worry. When you need your money, partial, immediately, you get your investment. You get the proceeds from your investment same day. Like a few weeks ago, I disinvested from such a thing, and within hours, I got my money back. Now, that's the kind of collective investment scheme or a unit trust that you should consider, because when you need your money, when push comes to shove, if you're going to spill someone's beans and gari, you need your money, you need the money to pay back. The money will be ready waiting for you. Great. Okay, so we have Mimi for a limited time. Mimi, so far we've been talking about comparing investments. We've talked about understanding risk and return, the different types of returns there are. We've talked about just now liquidity, how quickly you can get your money without, and what kind of charges they are involved. Do you have any thoughts on this? Any advice for our audience?
Yeah, I think this is an important conversation because we are encouraging each other to save and invest. So we want to make the most of our money. So it's important that we compare investments and do that well. And I mean, to be able to do that, we have to have the full picture. As was said, different people report their interest rate differently, and even in the reporting, I think I heard some use some, I don't know what to call it, some different standards and all sorts of things, for it. And some will try as much as possible to look better than they actually are. So, I mean, as much as possible, we should dig a bit deeper. But beyond the interest rate, the cost of, investing is also something that we don't look at. For example, when people are coming to invest at my place and they are like, I will come, I want the funds in the next year. I'm like, bruh, it's not going to be worth it because the penalty for, withdrawing in the short term is hefty. The funds that we invest are more for medium to long term, and it's supposed to discourage, short term withdrawals. So if you don't do your homework well of asking yourself what is the objective and the horizon, then you're going to be paying more to you are investing. And you probably show your statement to some friends and family, but really, 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 you are not getting the most out of your money. So I think these are some of the things that you should do. I think they've already been said, but I think they would help optimize, your returns. And as we're speaking, I was doing my background check on some funds I have and whether I'm optimizing, my money or not. So I think these are things that we should do. Unfortunately, for me personally, some investments that I would have done don't have direct debit. So you have to walk into the bank and do your own thing. I sometimes feel like that doesn't help. So for me, I have this investment where their direct debit works perfectly. I don't think it has ever failed me. So I use it to collect my funds. I get a bit of returns there, but not I don't believe it's optimizing my investments, but I use it to accumulate my funds, and then maybe once every quarter or so I go and deposit it in the places that have decided not to have a direct debit and make people's life easier. So that's the little I want to see.
Okay, that's great. That's great. Let me touch on a few things. Even on the returns, the different ways people show their returns to make them look better. You may hear a term gross returns and then net returns. You remember I mentioned that with these investment houses, we invest on your behalf, right? And what the investment houses get is the management fees. So after they've gotten the return for you, you pay them a fee, and that will reduce what you are left with. Imagine that you bring me 1,000 CDs, I get a return of 25% for you. So your money grows to 1,250. Then I say, oh well, please pay me 2% of the amount you invested with me. That's, let's say, 20 CDs. So you end up with 230 instead of 1,250. So if I talk about the returns as as in terms of comparing the what you started with, that 1,000, with what you ended with of 2,250, I'll actually be overstating your returns. So you always want to ask people, what is your net return? Because some companies will say they will charge 1%, some companies will say they will charge 2%. But for you as an investor, what really matters to you is, what are you getting? A crack saying, if someone will charge 3% and do a return of 40%, versus someone who charge only 1% and do a return of only 15%, you just have to ask, after all is said and done, what do I walk away with? And then you look at where you benefit most. That's your net return. And you can look at that option, of course, granted that all other things check out, right? So that's an important thing to note. Thank you, Mimi, for bringing that up. Also, that was a segue to other fees and charges, other fees and charges that you need to think about. Like Jennifer mentioned, some investments like the DataBank M Fund, I believe it's EcoBank's EDC Fixed Income Fund, they charge front load fees, whereas some other mutual funds or collective or unit trusts don't charge front load fees. If you go to a bank, you are doing a fixed deposit, they won't tell you about a front load fee, You may not know about that. Sometimes when you go to a bank, you are buying a treasury bill, they wouldn't give you the same rate that the Bank of Ghana was quoting. They will give you a slightly lower rate. So you just need to check if they are doing that with you. So all the time, whenever you're going to invest, ask, okay, I hear you have a good package, but what are the charges? What are the charges? Jenny also mentioned some have exit flow charges. When you are withdrawing, they will charge a portion of what you are taking out if you are leaving at ahead of when they had wanted you to leave. Let's see. David, are there any other charges that you know of? Oh, I know there are marketing expenses, there are taxes. Are there any others I'm missing, David?
No, I can't think of anything right off the top of my head right now.
Okay, great. Jenny, how about you? Any other charges that people should look out for?
Anything.
So we have Mimi, do you want to go?
Sorry, I was just being naughty, but when
I know where I come to see.
no, when they don't have when they don't have direct debit, which is affordable, transfer charges, e-levy, what you call transportation to the bank to go and deposit, they're all costs.
Exactly. It's true. All these things are costs to you. Adam, you want to chip in on this before we hear from Jenny?
I was going to add that for those who will be doing the stocks and what have you, your dividends are taxed. So you should also think about that one. Then I think there's also a capital gains tax. I'm not too certain of what the rate is, but there's something like that now. You should keep that in mind.
Exactly. You should keep that in mind, especially in the US in developed markets where these are enforced. In Ghana, it's supposed to be enforced, but they are still discussing those capital gains. But yeah, dividends are also are taxed. Jenny, you had wanted to add on?
Okay, so we have some charges that sometimes will not you will not see it directly. Like you see the way front load you deposit, and then you realize that if it's 1% of your money is gone, like on the it shows you that, oh, this is the front load charge. We also have some charges that are woven into. They may tell you, but then you don't see it on the face of the investments. And an example of this is management fees. So management fees differ from company to company. I think it can be like 1%, 1.25%, and then I've seen that some that are at like 2%. The way they work is that they are charged on the net assets of the fund at the end of every day. So if it's, let's say, 1% per annum, we divide the 1% by 365 days and multiply it by the ending value of the total fund. So as at the end of the day, so when they charge that, then they charge it to the fund. So you won't you will just be seeing it one every day like that. They'll be charging the management fee, and then you bulk it up at the end of the year and you realize that the percentages add up to 1%. So they have that. Some funds also have administrative expenses, and that's so you see, we have fund administrators who sort of work on the investments as well. So sometimes I think I've seen some that are 0.25%, 0.5% or so. So they charge that to daily, like the way they charge the management fee. These are all in the daily activities that the fund does. And you will see it hit your account, boom, once like that. But then it goes on. Thank you.
Exactly.
Anakim, I have a quick question.
Please go ahead.
Do we have no load funds in Ghana?
Can you please elaborate? What are no load funds?
So, like, there's no fees to get in or fees to get out, and maybe the only fees you're probably paying are the admin fees.
Oh yes, there are some like that.
Okay. Just checking. All right.
Yeah, there are some like that. So no entry fees, no exit fees.
Yeah.
Okay, great. So to avoid the confusion of is this a good investment for me in terms of the charges, just ask, let them tell you, and if possible, let them show you where it is written. Because some people may say something, but what was written may be different. And most importantly, read the fine print. Read the fine print. Because I'm always preaching to you to my convos that read documents. Loan documents, I read all the 30 pages. Lease agreements, read all the 30 pages. And go and ask all the questions I have to ask. And people say, okay, well, then I'll send you the extra information, send you this. It saves you a world of trouble. Let's all save ourselves all that trouble so that we can protect our money. We work too hard for it to let it go to waste. Okay, so for me, the last thing two more things, in fact. The last but one thing I want to say as another way that you need to compare investments is, and I wish Prince were here, insurance is not investment. Let's get that clear. Like, they are saying there's comparing investments, but when I ask people what investment do you have, then they say, I have an investment with an insurance company, or they have a certain life product. And my first question is that an investment? Yes or no? And you can listen to some of our previous conversations. I've forgotten which exact one, but in October last year, we had conversations about insurance. So you can always go and listen to those replays. With these investments, with these insurance packages that have some investment linkages to them, their main purpose is to serve as insurance, to cover your risk. You pay a premium so that if something bad happens, they will pay you or they will reimburse you or your beneficiaries. That's the purpose of the insurance. If you want to do investments, please go to an investment house. At worst, go to wherever you have your bank account, your savings account or your current account. But The investment that comes with insurance is usually something like an extra perk that is added to the main thing, which is to protect you from a bad event happening. All right, or to reimburse you when a bad event happens. So please, let's not confuse insurance with investment. So don't try too hard to compare a product from an insurance company with a product from an investment house, because in terms of the investment features, the investment house would always beat the insurance company. Please, my panelists, any thoughts on this point? If
Yes.
Prince is not here to defend it. Mimi, please go ahead.
For me, I think that they both serve different purposes. Much as investment would normally beat insurance, sometimes there are uncertainties in life. So, for example, if you did an insurance, or let me say an investment during Muhammad's time, and you did an insurance, okay, the insurance guaranteed a certain amount. Interest rates have gone down. They are now coming up, but they went down remarkably. You will still have that your guaranteed amount under an insurance, arrangement. Even though the interest rate they'll use as at the time you were buying it will be much lower than the insurance investment. But if things really go bad, you know that your money is guaranteed. So for me, especially when it comes to retirement planning, I would like to use the two. I think the two are important. Having some guaranteed, source of income or whatever it is, and then also having, a place where you can maximize, the use of your funds. So I think they both play different roles. But what hurts me the most is when someone is doing an insurance and in their mind they think they are doing an investment. I think it's heartbreaking.
Oh, it's heartbreaking, guys. It's heartbreaking. We don't want you to be sad. We don't want you to come out at the other end disappointed, thinking that all the money that you are putting away every month, you would get it back with interest on it. Okay. Any other thoughts on this? Okay. All right then. I guess the last point for me in terms of how to compare investments is really about who you are going to invest with. The reputation of the investment house or the reputation of the issuer or whoever you are going to do the bank fixed deposit. Sometimes there are proxies for you to know, but they are not foolproof. It just requires a lot of investigation in getting people who have good experiences over there. So it boils down to the reputation. But first thing you need to check, are they licensed? When you want to do an investment with an institution and they start telling you that we are not licensed by this company, so they can't tell us they are not licensed by Bank of Ghana, or we are not licensed by this or that. They can't tell you, they can't say that our investment is bad or something like that. You need to take caution, relax, and find out more. Don't be in a hurry to send your money there. Even more so when you have the Bank of Ghana issuing notices to be careful about those type of investments. You need to be careful. As a side note, some people sent their money to Men's Gold, even though they knew all the back and forth that was going on with the Bank of Ghana and why they were saying that don't invest there. And some people came out to say, well, even if Bank of Ghana said they don't regulate them, they saw a picture of Namwan with Utumfo and pictures of Naman with the president at the time. Was that Mahama also? So they are like, well, then if you take pictures with those people, they would be comfortable taking their money there. Please, let's get serious. This is serious money. This is serious money. You worked hard. You need to protect it with that same level of seriousness. Or maybe it came as a windfall, but regardless, don't be in a hurry to throw away your money, right? Again, why do we say these regulators are important? David, perhaps you can back me up or verify from your side of the world. As an investment professional, I don't think any institution will talk about investment or any form of investment and say that they don't fall under any regulator, because the Bank of Ghana, the way our law is structured, the Bank of Ghana actually lists in their act, lists all banking activities. Then the SEC, the Securities and Exchange Commission, effectively, not quoting the law, but effectively is like everything else comes under SEC. Immediately you start doing things that walks like a duck, quacks like a duck, it goes under SEC. And that is when you follow the story of Nam1 and Men's Gold, the whole house of cards came crashing down. It got to a point where they were really, Men's Gold was really at it with the Bank of Ghana, and SEC stepped in and said, okay, fine. You said you are not licensed by Bank of Ghana, no problem. What you are doing sounds like you are doing gold. I've forgotten the right term. Is it gold collectibles kind of investment? So no problem. This is what you do. Come and explain to us how you do what you do. And it's at that point that they started closing their offices and not opening them. And here it was a simple question SEC asked them. You say you're not licensed, you don't have to be licensed, no problem. We have defined that the activity you do is this. So come and explain to us how you do what you do. They would try to say it's proprietary, blah, blah, blah. It can't be too proprietary to the regulator. It's an institution that has been set up to protect the public. So you really can't dodge, David, what do you think about this all-encompassing view of the SEC and regulators?
So when it comes to regulation, that point cannot be stressed enough. When an investment house is being regulated by, let's say, the Bank of Ghana as the premier regulator of Ghana, right? It's a badge of honor for them that they are being regulated by the Bank of Ghana because it gives them legitimacy. So in my part of the world, if you're regulated by, let's say, Bank of Ghana, for instance, as the number one or the main regulator, it is on all their correspondence that they send out. Oh, if you look at even their website, underneath there's going to be a line that says regulated by the Bank of Ghana. Oh, that gives them legitimacy so that when you are trying to invest with them, you have a level of comfort. Say, okay, this company being regulated by the Bank of Ghana, they made sure, say, they have certain things in place where there's going to be a least likelihood of fraud and stuff. So please, if you want to go invest with somebody, always make sure that they are regulated by the top one. Sometimes some people or some entities will try to circumvent that thing and say, oh, we are regulated by the Greater Accra Regional. No. They do that because they feel like the Greater Accra Regional, whatever entity, that's a fake entity, by the way. You would think, say, oh, they are being regulated. But maybe that entity, their regulation is not as stringent as the Bank of Ghana one. The Bank of Ghana one might be too much for them, so they go with the regional one, which is not that stringent. So please make sure you are looking out for that. In my part of the world too, right? There is a website. There's a place where you can go look at, oh, this company, is it regulated by the country's regulatory body? And if if they have any history of misappropriating customer funds, all of it is going to be there. You can see it and say, investment house ABC. When you go there, they are misappropriating your funds. They are doing this. One of their reps, and even the reps themselves. Let's say, I don't know, David works at ABC Investment House. You can pull up David's name and see, okay, since the time David has been licensed and worked at, ABC Investment House, has he had any history of misappropriating customer funds or putting them in unsuitable types of investments? You can see all that, and these are public records. So it gives you a sense of comfort. So, okay, I'm going to this house to go and invest with Rep ABC David. This is David's history. His company that he works with, this is their history. So that part is very, very important. So thank you.
Thank you so much, David. See, the system is working over there. The system is working. We in Ghana will get there soon. Until we get such a detailed system in Ghana, the Securities and Exchange Commission website has a list, and even Bank of Ghana, they also keep a list of institutions that are properly licensed with them and of good standing. So just visit bog.gov.gh bog.gov.gh, and SEC is sec.gov.gh. Just look out for the licensed institutions, right? I'll just share a story that I've shared here on Money Convos before about when I was much younger in the investment industry and the importance of the license. When we say licensing is important, it is so. Right now, if I go and misbehave and my license is taken away from me, there's this concept of fit and proper person. It will be on my permanent record, and I may not be able to be involved in any proper business at a high level or work even in the industry again in any reasonable capacity for a number of years. Like an uncle once told me when I was about to start my national service, he said, "I see, if I come and work in his company selling things for him, and he fires me, no one will care. But if I'm fired from a financial institution, nobody cares whether you just showed up at work late, so they fired you or whatever it is. They'll say, "Wako Yasika, you've gone to steal money." So the onus is on us that we are licensed to make sure that we behave well. So when you hear people in an industry that is supposed to be regulated, behaving as if there are no laws for them, or acting anyhow, or talking loosely, yawa opai. Now, this story that I was going to talk about, I went to, I invest, I manage investments for high net worth individuals. So I was going to pitch to a client, and we do visits either in their office or home. And this was a new investment that we had. And when I went to the person's home, it was a woman, and she wanted her husband to sit in on the conversation. He didn't want to. She had to call him a few times. When he eventually came, he sat there. He was quiet the whole time, and she kept trying to rope him into the conversation. And while I was explaining the thing, yeah, there are no guaranteed returns. If you want your investments, we'll have to sell it, and we'll see what kind of returns, how much you get from it. So you may win, you may gain, you may lose. I was going by the book. The potential client got frustrated, and she was like, "Look, I called you here to come and sit here to listen to this so that you can advise me." And she said, "This man, he works at SEC. He works at SEC." Then it suddenly clicked to me, the woman's surname. She's the wife of the head of the department that we do our regulatory filings to. All our letters are addressed to this man. Any rules coming from the SEC is this man who signs. And he is there sitting in front of me. If for the last hour I was just lying to this woman, I would lose my job there and then. Like, I know that I think I went on a Sunday. Monday, when I'm going to office, I'm either preparing my resignation letter or I'm screwed. And he was like, "Okay, well, yeah, he didn't want to talk because he works at SEC, but yes, what the young man has said is true. He can't guarantee you the investment. It may do well or it may not do well, blah, blah, blah." And I breathed a sigh of relief. See, my whole career, all my 7 years in the investment industry, I haven't been that relieved more than 5 times to know that I stood a blind test and I succeeded. So imagine if someone comes on radio and they are telling you that they can do whatever, they can do this, no one regulates them with such bravery and bravado and without recourse. And you have to run with take your sandals. If your sandals or your slippers will slow you down, hold it and run. Okay, it's better to keep your money and make no returns than to go and chase high returns and lose all your money. All right, you work too hard for it. Anyway, on that bombshell, let's see, Jenny, do you have any closing thoughts for us? And then we'll come to Edem and Mimi and then David.
My closing remarks is that you can never be too careful with investments. Read all you can, ask all the questions you can before you commit money, because there's there's a saying in Chi that says that anona yede bobusi ananye no an yedi tiaka, which means that the money that people will use to collect money from you to invest, that's not the same mouth that they'll use to pay it. So be very careful when you're committing funds and investments, and do your due diligence well, and make sure that as you keep being apprised of whatever goes on. If it is quarterly, you get your quarterly report and all, and always have in mind the way that if you want to get out, it is easy, and the potential loss of value or not that you have to incur you want to listen to be doing. Thank you.
Thank you so much, Jenny, for the proverb. There's also this one I like, Okafu Didi. Someone who owes eats. So calm down. Don't give too much pressure. Okay. Adam, how about you? You've heard what we've advised. How would you make this all play out for you in summary?
Okay, so for me, one of the areas I really pay attention to is the fees and the, the silent charges that we don't see, the not so obvious things. So ask questions, like Jenny said, ask questions, ask questions, ask questions, and then read the fine print. I think that is what I've gotten out of this discussion. Thanks so much.
That's great. Ask questions and read the fine print. Wonderful. Mimi, how about you? Closing thoughts for us?
Sorry, I agree with everything that has been said. Investment is good, but we have to do it the right way. As Jennifer said, you can't be too careful, because I was just discussing with a colleague. So what if government defaults, like a few people are predicting? So there's risk everywhere. So you can never be too careful. But invest anyway. It's necessary if you want to be able to achieve your financial goals. It's important to invest. For me, I think that if you struggle, investment is somebody's job. So if you struggle with, being able to do all the things that have been said today, you can just reach out for help, and I'm sure you will get some good help to be able to settle on whatever investment you want to do. At the end of it all, make sure it's something that you understand and you want to do, not because Akosia said the interest rates are good, but something you understand and you've answered all your questions and it's the right, product for you. So that's just what I want to add.
Great. Thank you, Mimi. Investment is good, but you have to do it the right way. I like that. I like that. David, how about you? What would you like to leave us with?
So, some of what I want to say has probably been said, but I'll just reiterate them again because I wrote them down, so I just don't want to miss anything. Number one, ask enough questions till you're satisfied with what it is that you're putting your money into. Okay. There may be terms thrown around, APR, interest rate, this, that, year to date, annual return. Ask enough questions. Okay. Do your due diligence. I don't like when I was trying to do research on some of the investment houses in Ghana, I was having a little bit trouble finding stuff out on their website. I'm told lots of them have improved. If there's information on the website, if there's some hard copy place where you can go and read about them, do that. Make sure that you're picking the right investment house to invest in, the right representative. If there's any, resources that tells you about, okay, investment house ABC, what kind of regulatory records, they have, history that they have, if they are, if their past history says people who invest with them end up losing their money, then, advise yourself. Go as detailed as even the person that if you're investing with Elichem, like I said, in my part of the world, I can go on some website and go and see, since Elichem got his investment license, all the wahala he's been doing, has the regulators gone after him for misappropriating customer funds? All of it will be there. Read about those things, be comfortable. And please, when somebody is promising you these crazy returns and they are telling you that they are not regulated by the biggest national regulator, have some pause. Okay, there's a reason why they are not being regulated by the regulator. Have some pause. Don't just go jump in head first. Oh, here's my life savings. Take it because you say you're going to double my money every day. At some point, just ask yourself, if this thing was true, is it sustainable? And then if you think it is, then by all means. But for now, that's all I have. So thank you very much. Invest wisely.
That's a good one. That's a good one. Thank you so much, David. I like that ending line. Invest wisely. Jennifer, doesn't it ring a bell?
Invest wisely.
Yeah. Let's not do any adverts for now. Okay, great. Thank you all so much for having us engage in this conversation to know what to look out for.
Real quick, please. I
Okay,
forgot to say something. Take advantage of groups like Money Convos, where people who work in the industry are giving free gems. Take advantage of that. I know it's a shameless plug, but what Money Convos is doing, right? It's something that you'd go pay lots of money for. It's free advice, and we're not necessarily telling you go and buy A or go and buy B. All we're telling you is here are the pros and cons of buying A versus buying B, and then you make that decision. So in doing your due diligence and your research and stuff, take advantage of groups like Money Convos or whatever else may be out there. There's very, very good information being shared that, is very valuable too. Thank you.
David has done the advert for me. I won't do the advert. I'll do it again. Now I'll do it. You can't have enough. Yes, thank you so much, David. It's important. And for me, my point was talk to somebody, talk to a pro, and which better pro is on your side than Money Convos. All of us up here on stage, we are looking to help you achieve your idea of financial independence from whichever level of wealth you have, you are starting from, or level of income you are starting from. And we do this with no strings attached. We rarely even mention our institutions' names. We may mention them, but not even say, "Oh, we work here, we work there." We don't have sales targets. We are not trying to sell anything to you. We just want to make sure that you are well informed to make the right decision. So, like David said, reach out to us. I was just replying to a message someone asked on Twitter in a direct message. People are asking us questions. They are curious about things. Just send us DMs on Instagram, Facebook, Twitter, or you can even put it out in the public if you are comfortable with it. But yeah, feel free to reach out. If you have our personal numbers, to reach out to us. If you want to reach out on Clubhouse too, you can use the back channel, the messaging. Message us. Just contact us anywhere on social media, Money Convos GH, or send an email, moneyconvosgh@gmail.com. And if you are also interested in personal finance, either you're a professional or you are just someone planning your own trade, doing whatever, but because money is so important, you also want to spread the wealth, please feel free to reach out and let's see how you can also help out with Money Convos, to reach out to other people. We want to spread the word and help more people become financially literate. And hopefully in 5-10 years to come, we'll all be at whatever levels of wealth we want and we'll be happy. Have one less problem. That's one less money problem in our lives. We were looking to have a conversation about my money story with Deborah Amakute this week, but she was under the weather. So hopefully it should come on the next week. We will be having a conversation with someone else you've heard from us so many times. But there's another person who has gone through her 20s and her 30s and has made many financial decisions, many life decisions, and we want to learn lessons from her life too. So we hope to have that conversation next week, Thursday at 7 p.m. GMT. And on Monday, we continue with our book, Rich Dad, Poor Dad by Robert Kiyosaki. Check out the last session we had on Tuesday on YouTube Live. It's on our YouTube channel, right? It's an very interesting conversation on the need for financial literacy. I strongly encourage you. We said something about acquiring a home, whether it's an asset or a liability. You really want to go and check that. All right then. Thank you so much for spending your evening with us. Thank you to our panelists for making the time, as always, to come and share your wisdom with us. To our regular audience, Ifriye, Michelle, and to new faces I see, Mike, Kasiwa, Star. Thank you so much for being here with us, and I wish you a pleasant Friday and a pleasant weekend. Do get some rest so that you can get back to making money next week. Bye-bye.
Good night, guys. Good night.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook. And subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.